So hello students, greetings of the day. So in this video I will be explaining RTP, that is released for November 2022 examination. I will be explaining economics and finance subject. Okay, let us see the questions and answers given by ICAI. First question 1A. What is the value added method in the national income accounting? So basically when it comes to national income accounting, we have three different methods, right? So he's asking about the first method, product method. Let us see the answer given by ICAI. So the entire answer is there in our material. In our material, the answer for that question you can find in national income accounting question number 11. So the content that is given in our material is more than sufficient. In fact, the answer that is given by ICAI is very concise. Okay, so we have added formulas also. So all the points that are given in the first answer is already there in our material. So as it is, if you write it, that is more than sufficient. Okay, so we have to give brief introduction about value added method, what is the procedure, and what are the items that are to be included and excluded while calculating national income under value added method. Okay, that is the first answer. Next one B, in a three sector model, what role does the government play? So in three sector, the difference between two sector and three sector is government. So when it comes to government, it will try to influence the economy in two ways, with the help of taxes and with the help of government expenditure. So when it comes to three sector model, when it comes to equilibrium point, it is nothing but aggregate demand equal to aggregate supply. That is nothing but C plus I plus G equal to C plus S plus T. So consumption is common. So at the end of the day, we'll try to explain the relationship between S plus T and I plus G. Okay, so here T and G both are related, both the components are related to government sector. Okay, so government will try to influence the economy with these two, that is taxes and government expenditure. The same thing is given there and it is already there in our material. Okay, next 1C, calculate net national product at market price. So he is asking us to calculate NNP at market price. Under which method is not given. So just by going through the data, we should conclude which method is to be used. So let's see the data given here. Items, compensation of employees, profit, rent, interest, and mixed income of self-employed. With these items, we can calculate NDP at factor cost. Okay, and if you add NFIA to it, that is net factor income from abroad, you will get NNP at factor cost. And to that, if you add net indirect taxes, you will get NNP at market price. Okay, so just by using income method, we can calculate NNP at market price. As I said earlier, compensation of employees, rent, interest, profit, rent, interest, and mixed income of self-employed. If we add these items, you will get NDP at factor cost. To that, if I add net factor income from abroad, you will get NNP at factor cost. To that, if I add net indirect taxes, you will get NNP at market prices. So let us see the first answer given by the ICAI. So up to NNP at factor cost, it is correct. But when it comes to NNP at factor cost, up to NDP at factor cost, it is correct. But when it comes to NNP at factor cost, the formula given is right, but the values they have given it wrongly. Okay, so basically what they have done is that this part is completely wrong. This part is completely wrong. Okay, because NFI means factor income from abroad minus factor income to abroad, right? So if you look at the answer here, this net current transfers to abroad is not factor income to abroad. It is basically a transfer payment. Transfer payment. Net current transfers to abroad is not net factor income to abroad. It comes under transfer payments classification. Okay. So unfortunately in such answer he has considered it and moreover he has rejected it. Okay. So moreover when it comes to net factor income from abroad, you have to add it, right? You have to add it, but he has subtracted it. That is completely wrong. So 1960 plus 25, you will get 1985. So once you have calculated NNP at factor cost, if you add net indirect taxes, you will get NNP at market price. So you have to make a small correction in such answer. If you are thorough with the concept, you can easily find the mistake. Okay, right. Next 2A. What are the challenges in compilation of national income accounting? Last question. So what are the challenges, conceptual difficulties that we face while calculating national income? Only part of the question is asked. So we will answer only that part of the question. Okay, so the same thing is present in our material as it is. Okay, if you present the same thing, you will get full marks for that question. Next, does government intervention always result in correcting market failure? Basically here we are talking about government failure. Government failure. Sometimes instead of solving a problem, government may create a new problem. Fiscal functions chapter, important question. Fiscal functions chapter, important question. This point is important. While explaining the chapter itself, we mention it. We will mention it repeatedly. That specific question is very important. So Government is there to intervene, rectify a problem, but instead of rectifying a problem, government will sometimes create a new problem. So this is called as government failure. If government failure is only limited to wastage of resources, it is less serious. But along with wastage of resources, if it is affecting the welfare of people, then it is more serious. Okay, the same thing is given here. Same question is present in our material. Okay, so everything is given. Intervention is ineffective, causing wastage of resources. Intervention produces fresh and more serious problem. Okay, the same thing is given there in our material also. Okay, so basically what they are saying is that what the meaning of the question is that whether government will always solve the problems, if not what? Sometimes instead of solving a problem, government may create a new problem. That is called as government failure. Okay. Now 2C1. Calculate narrow money, nothing but M1. What formula for M1 is? Currency with public, demand deposits with banks, and other deposits with RBI. If you add these three, you will get M1. Let us see the answer given in the material. Same thing is given. Same thing is given. Okay. Right. Next, 2C2. What will be the value of average propensity to consume or average propensity to save? So we knew the formula for APC. APC is nothing but C by Y. He is asking APS, right? AP is nothing but S by Y. S by Y. So you can easily calculate with the given data. You can easily calculate APS. Okay, right. So here consumption and income is given. If you subtract consumption from income, you will get savings. And in this point number 2, consumption savings are directly given. So S by Y, you will get average propensity to save. Okay, next 3A. What do you understand by arbitrage? What do you mean by arbitrage? Important question from exchange rate chapter. While explaining the chapter itself, we have mentioned it couple of times that it is very, very important. And it was not asked in examination, in earlier examination. So there is every possibility that the question may be asked in coming examinations. Repeatedly asked in MTPs and RTPs. Okay. So what is arbitrage? We all know, buying and selling of same product in two different markets at two different prices to take advantage of changes in price. The same thing is explained here. The same thing is explained here. Okay, right. So when we generally what we do is that we buy in low priced market and sell it in high priced market. In doing so, what will happen? The price in low priced market start increasing and the price in high priced market starts decreasing. That entire process is called as arbitrage. Okay, right. Next. What are the factors that causes leakages in the multiplier? Keynesian theory chapter. Keynesian theory chapter. There is a specific question. There is a specific question just after the completion of two-sector model. In Keynesian theory chapter, just after completion of two-sector model, we have this specific question. Okay, where all the points are mentioned which lead to causes for leakages. Which are the factors that cause leakages? Okay. So those points are mentioned here. The entire question is there in our material in Keynesian theory determination of national income just after completion of two-sector model. Okay, so you can see the question in our material itself. So all the points which are given here are covered in our material. Okay, so depending on the situation, you have to decide whether to write all the points or any 6 of the given points. Okay, so all these are factors act as leakages. Next, 3C. How changes in high powered money and currency ratio influence the money supply in the economy? Basically, he is talking about behavior of central bank and behavior of people, public. Let us see the answer. Here, but instead of answering that, he has given answer regarding excess reserves. So, answer is wrong in such answer. Okay. This should not be the answer. The excess reserves, which are funds that banks keep beyond what is required by regulations, form a very important determinant of money supply. So this part is regarding excess reserves. In the question, what he is asking about high-powered money and currency ratio. Currency ratio means currency deposit ratio. That means public behavior. So behavior of central bank and behavior of public. You need to write the behavior of both the central bank as well as public now. So this should not be the answer. The answer is there in our material, which is clearly mentioned. Okay. So how the behavior of commercial bank, how the behavior of central bank, and how the behavior of public will affect the money multiplier and money supply in an economy. There is a specific question in our material. If you go through that question in money markets chapter, you can easily understand. Okay, right. Next, which type of policy is preferable during time of recession? In time of recession, government needs to expand the economy. That's why it will take expansionary fiscal policy. The same thing is given here. Because during recession, there will be lack of production. Why there is lack of production? Because there is no demand. Why there is no demand? Because there is no income with the people. So what government has to do? It has to increase the income of the people. When the income of the people increases, how the government will increase the income of the people? By increasing its government expenditure and reducing the taxes. So here the objective of the government is to increase the income. When income increases, consumption increases. When consumption increases, demand increases. When demand increases, production increases, and we can come out of recession. The policy taken by the government to increase the income is called as expansionary fiscal policy, given here. The same thing is there in our material fiscal policy chapter. Next, distinguish between Cambridge and the classical version of quantity theory of money. That means is asking to differentiate between QTM, quantity theory of money, given by Irving Fisher, and Cambridge approach, given by four economists or four economists, Alfred Marshall, A.C. Pigot, Roberts, A.C. Pigot, James Keynes. Okay, and there is one more economist. Okay, right. So the same thing can be written either in the column form or theoretically. First, you will write about Cambridge approach. The formula is MD equal to K of P into Y. And then you will write about QTM, quantity theory of money, given by Irving Fisher. Okay, right. The same thing is given there. So basically, distinguishing means we need to differentiate. Either you can prepare it in a column form, tabular form, or you can write it like this also. First, you will write about the first part of the question. Next, you will write about the second part of the question. Next, on a 4B, what is meant by crowding effect? Important question again from fiscal policy chapter. Crowding effect. What do you mean by crowding effect? Here, crowding effect means we are discussing about the competition. When there is competition between government and private sector, who will prevail? And what sort of effect it will have on the economy? There is a specific question in our material at the end of the chapter. Okay, and while explaining also, we have said it multiple times. That is very important question asked multiple times in previous examination. Still, there is every possibility that it may be asked further in future examinations also. The same thing has been proven by giving that question in RTP. Okay, so crowding out effect. What is crowding out effect? Everything is given here. If government starts competing with private sector for funds, the interest rates increases. When interest rates increases, private sector will not be able to afford those funds or loans. So automatically funds will move from market to the public sector or government. Because of this, what will happen? There will be scarcity of funds with private sector. Private sector will not be able to invest. They will reduce their business, and slowly when they are unable to get funds at lower interest rate, they will stop doing the business. So since government is competing with private sector is exiting from the market. That is called as crowded out. Private sector is being crowded out. Okay, so that is the answer. Next, how does appreciation, depreciation of currency affects real economy? Real economy is in terms of output. So if there is a depreciation, there will be increase in exports and decrease in imports. If there is depreciation of rupee, if there is depreciation of rupee or home currency, exports rises, imports declines. Okay, and if there is appreciation of rupee, then what will happen? Exports decline, imports rise. The same thing is given here in a much elaborate way, and the same thing is present in our material also. So almost all the questions that we have discussed till now are all in our material. Okay, next. How do trade policy influence international trade? So how do trade policies influence international trade? Basically, we are talking about the introduction to international trade chapter. Okay. So trade policy encompasses all the instruments that government may use to promote and restrict exports and imports. So how do trade policy influence international trade? So basically trade policy, trade negotiation chapter is there, right? So from that first question. Okay. So the entire question is given here. Trade policy also include the approach taken by the countries in the negotiation. See, trade policies act as a base for trade negotiations. If the policies of both exporting country and importing country are same, then there is no need to negotiate. But since both these countries have conflicting objectives, their policies will differ from one another. So in order to have a common understanding, these two countries have to negotiate. So negotiations depend on the kind of policy these countries adopt. Okay, same thing is there in our material as this question is given. Next, Nana, 5a. What is the characteristic of private good? Features of private good. Almost all the goods produced in the economy are private good. Direct question from our material. That question is present in our material. Okay. Government market failure and government intervention in case of market failure. That is a chapter name, and question is there in our material under public goods classification. Okay. So the same question we will write here also. Next, what are the features of private good? They are rival and they are excludable. Okay, they are rival and they don't have any sort of free rider problems. So all these features that we need to write. Okay, right. Next, domestic industries and consumers are affected by import quota. Comment, yes. What do you mean by import quota? If the government is imposing binding quota, that means the quota is below the free trade level. The amount of import that is allowed is below the free trade level. Then automatically imports decreases. It leads to scarcity of imported goods in the market, and people are dependent more and more on imported goods. Automatically demand for imported goods will be high. When the demand for imported goods is high, price of the goods increases. So earlier the seller of imported goods may be selling the goods for 10 rupees. Now he will be selling the same good for 20 rupees. See, there is no change in production cost, but there is change in prices. Why there is change in prices? Because of demand, increase in demand. So if the government has imposed binding quota, we will be able to import only less quantity than what we were importing earlier. So earlier I was importing 10,000 kgs, now I will be able to import only 5,000 kgs because government has kept a restriction that you can't import beyond 5,000 kgs. So this leads to scarcity of imported goods in the market, domestic market, increases the demand for imported goods. Price of the imported goods increases. Now the seller of imported goods will be able to earn more profits than what they would have earned earlier. This excess profits that they are earning is called as import quota. It will affect the consumers in a negative way, and it will affect the domestic producers in a positive way. How, sir? When the price of imported goods increases, automatically consumers can shift from imported goods to domestically made goods. Okay. So all those points that we need to write here. Okay, so this quota, this excess profit that the importer earns is called as rent, quota rent. Okay, right. Next, what determines the size of money multiplier? What determines the size of money multiplier? Reserve ratio. Higher the reserve ratio, lower the money multiplier. Same thing is given here, and we have this formula also in our material. Money multiplier equal to 1 by R. Capital R, nothing but 1 by reserve ratio. Higher the reserve ratio, lower the money multiplier. Next, in the theory of international trade, what is meant by factor endowment? Factor endowment means we are talking about availability of resources. So in general sense, factor endowment refers to overall availability of usable resources. What is the amount of resources that is available for production for international trade? Here, when we talk about international trade, the important resources are labor and capital. Labor and capital. Okay, so that thing we need to write here. Next, this is also present in our material, especially when it comes to Heckscher-Ohlin theory of trade. There you have it. Okay, in the introduction part itself, Heckscher-Ohlin theory of trade. Question is right. Question is there, right? In that question, we have this answer for this question in the introduction part of that question itself. Next, define narrow money. We all know what is narrow money. M1. Okay, so M1 is nothing but summation of currency held by the public plus demand deposits of banks plus other deposits of RBI. Here banks include both commercial and cooperative banks. So all questions are present in our material, and the same pattern will be there in examination also, and same standard will be maintained. So if you are thorough with Masterminds material, you can easily answer the question paper and you can secure good marks. Okay, so all the best for the future examinations. Thank you.